to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and today we're going to have a weekly strategy roundtable discussion. This is my brief bio. You can always pause the screen if you need more time to read the disclosures. Disclosures are important. All right, let's talk about what we see in the market. I think that's the main reason we are here. And again, everybody's kind of digesting Turkey and not much price action or not much of the new information that I can see. In terms of 3-year yield, 10-year yield, you know, we're approaching slowly 3.5%. I would watch that. If we break through the 3.5 to the downside, I think that can create more room to the upside. If we don't, if we just kind of trade sideways in this range, I think then, you know, the rally is kind of coming to an end. Same price action was $1. Happy Thanksgiving, Don. Happy Thanksgiving, Peter. And then spiders, the indexes themselves. The good news, again, day one usually doesn't set the trend, right? We tried to break through 400 in the middle of November unsuccessfully. This time we are day one, we are at 400, day two, day three, right? The longer we stay above 400, the higher the likelihood that the next level we're going to retest is this downward trend, right? This is an important line, right? First point touch, right? So we did this first touch here, second touch here, third touch here, and now it's in this. So I think this is the range where we might trade going into the CPI data, right? CPI data is going to be the first 2 weeks of December. So for now, as long as we're staying above 400, the path of least resistance to the upside, you can clearly see that momentum is deteriorating, right? This is not a sharp rally like we have here. It's kind of more of a consolidation phase, very similar to this setup, right? We traded in the range, broke out, consolidated, you know, and then moved a little bit higher, right? Right after that, and then we pulled back. So it could be something similar, right? Something similar where we can go higher. Especially if we have better than expected CPI, right? If we have better than CPI, then we can still go a little bit higher, consolidate, and then into the earnings pullback. But for now, again, the most important stop is I would say 400 level, right? This is this first stop level. This is kind of a short-term, pretty weak. 390, you know, that's much longer, right? The entire month of November, you know, except this, we spent above 390, right? So it was the low last week, it was the high end of October. We did break through it briefly here, but so 390 is the main support too. Right, so if you want to go long, you buy 402.58. If you're day trading, I would obviously put somewhere around 399, 398, your stop loss. If you're trading with few weeks as a timeline, then I would put 390, so 388, right below the 390 as a stop too. Technology is down and spiders flat, value outperforming. So that's about it in terms of what I see in the market. Any other questions? Peter down, happy Thanksgiving. All right, anyone else? All right. In terms of rules, right? Very important to have rules. I would treat trading as a business, managing your own business. You have to have rules and you have to document them, right? I would not have this kind of a mental rules. I would write them down, right? So they don't change, because what you remember can change, right? If you don't remember or you're under stress, well, then, okay, you forget things. In business, you always have operating agreement, right? You have bylaws. So whatever you have to run your business, it's written down, right? In order to raise money, you have to have 55% of voting members authorize additional, debt. right? It's the same thing, right? Every time you want to trade, a risk more than 2.5%, somebody has to authorize it, and it can't be just a split-second decision in your head. It has to be a process. When you have a process, and when you write it down, you have to submit the request. Things slow down, and it's much harder to do. So for that reason, I encourage you to make this process of deviating from the trading rules as hard as possible, right? Every time you want to have more positions or greater position size, write down a request, right? Write a Word document, request it, sign it, send it to yourself or send it to your spouse. I don't know who needs to approve it, right? So you have these checks and balances, but at least write it to yourself, submit it, look at it. And if you really want to break that rule, then fine, or raise that cash, right? Then fine. But you have to create certain obstacles. So these rules are important. I would encourage you to write them down. Keep a journal. It's very important. In the journal, again, if you think we're in the bull market, I would say 30% of your portfolio should be in cash. If you think we're in the bear market, I would say 50% of your portfolio in cash. Again, my thought process is this pattern is going to continue, right? This is not the end, right? Lower highs, lower lows, lower highs, lower lows, right? So we're going here. I mean, it might be a little bit higher, right? Right, that's possible, but this is coming, right? This is coming. I don't know. It's January, February, March, somewhere between January and March as we're approaching the earnings. Probably after earnings season starts, right? So middle of January, banks will come out, and if they say that, what, the credit card defaults is increasing and it's impacting our bottom line, and we're letting go some of the employees and stuff, then the market will sell off. Because right now, the market is not factoring in that the higher interest rate environment is going to impact significantly future earnings. So nobody has revised the earnings to the downside. I mean, they have revised it, but not to account for, recession or prolonged interest rates. So if that's going to happen, and that's my view, then there's a pullback. So then I would say 50% of your portfolio in cash. If you think that the earnings, in January and in April, Q4, Q1 earnings are not going to be significantly impacted, we're still going to have a single-digit growth in S&P 500 stocks, well, then the market is going higher. So, so there are literally only two possibilities, right? Soft landing and hard landing, right? Hard landing, we're going down. Soft landing, we're going up. I mean, in both cases, I guess, can happen, right? It's just the probabilities, right? In my view, this is maybe a 20% confidence level that we're in soft landing, but possible. Hard landing, my opinion, I'm 80% confident that we're going to be in hard landing based on what I hear with the research. Some people have other opinion, right? So now the trading is just based on your opinion and your, how much money you're willing to invest and risk, right? So if you're in soft landing, I would still have bullish and bearish position, because if you're wrong, then the market pulls back 20%. It's a pretty significant drawdown. If you're hard landing, I wouldn't be aggressively bullish because aggressively bearish, right? Even if you're in hard landing, I would not be aggressively bearish, because this, this consolidation can continue, throughout December. It actually can continue in January. Hard to time the market, right? So it could be next 2 months we're still in this consolidation phase, right? Maybe longer than we were here, right? Because from the breakout to the start of pullback, and there was maybe 4 weeks. 4 weeks. Here we're already 2 weeks. 2 weeks. So if it lasts in January, then it'll be longer, right? It will be a little bit longer. So that's my view on the market, and those are the rules that I encourage you to consider. 30%, 50% of your portfolio in cash if you think we're trading in a bear market. And then portfolio drawdown. It's all about position size, a number of positions. I propose 4 positions, right? The next rule, first rule is cash. You write it down, right? Big letters, you type it, and you keep it. This is part of your operating agreement. The second part of operating agreement is number of positions. That's pretty easy. Just never have more than whatever number you decide. On average, I think it should be 4. It could be 3, it could be 5, fine. But based on your experience level and your portfolio size, you decide, let's say 4, and it's always 4. No, it's not 2 and it's not 20. And then 2.5% of account value per position. Right, very important calculation, not a very trivial task, very difficult. The way it works for me, at least, let's say I'm bullish, right? I think we can continue going higher a little bit, right? So not comfortable doing day trading. So I see, okay, this is last week low, 390. Okay, that's my stop loss, right? So if I'm buying now, I'm risking 12 points. 2.5% of my account, $10,000 average account, it's $250. Right. 10K, 2.5%, $250. 20K, 2.5% is $500. Right? If you're managing $5,000, okay, you're not risking more than $125. Right? So average account is 10,000, $250. If my stop loss is 12 points, right? Well, I can buy 20 shares, maybe 20 shares of S&P. So then I'm not risking more than $250. And if market drops below, let's say this line, right, 388, 385, right, that's the CPI gap, then I'm out, right? And I'm not losing more than $250. It's still a trader's market. It's very important to have this negative visualization and positive visualization. If you day trading, maybe you say 400 or 398. If you're trading, weeks or months, I would say 385 is your line in the sand. And then if we drop below this line, then I think there is a high possibility we'll retest the lows, sooner than later. Okay, any questions? Spiders flat, QQQ slightly down. Let's see. What else do I want to talk about? 1 second. Look. Okay. So the next rule. So we talked about cash. We talked about number of position size, right? For stock, I use spiders as an index. If you trade in individual stock, it would be the same idea, right? You would look at the immediate support, right? If you're day trading or a little bit longer, you find, or you can just say spiders, right? If spiders drops below this level, if you have average technology stock, average, value stock, it's also going to drop, right? So you use these levels to potentially trigger your exit from other positions. And always the same amount, right? Doesn't matter, you trade in Bitcoin or you trade in something more volatile or less volatile. These are your risk levels. So risk management is extremely important. The second rule is if you trade in options, what strike price to select, right? So if you trade in spiders, I propose not to have $40,000, right? So if you have $40,000 account, then you can buy 1 contract of spiders, right? Because even if you buy a call or you're buying, unless you're trading spreads, right? You can do a $5 spread on spiders. It's a liquid name, and basically say, okay, I'm not gonna, if I lose half of the spread, $250, then I'm out. You could, But I propose still, because you want to treat it as a cash secured put, at least I like to do this, then you just don't trade on a $40,000 account, you trade spiders. On a $28,000 account, if you have 28K, then you're trading QQQs, right? Because one contract is 28,000. So even if you're trading spreads, it's still a derivative of the option. 1% move on spiders, you down $4, right? 1% move on QQQ, you down $2.80. Irrelevant, your position size, right? So on a $10,000 move, if you're trading spiders and it's moving 1% down, then you're down $4. Here it's $2.80. So on a $10,000 account, 1% moving QQ, which happens every day, then you're still within limit of $250. But on spiders, $400, that's outside of your limit. So very quickly it can move 1%, and you're already down more than the rule that you specify. So then you just don't trade spiders if you have $10,000 account, right? You trade maybe CSX, right, or some kind of ETF. I propose XLK, right? XLK is pretty liquid. It's pretty highly correlated to QQQ and spiders, so it's a $120 stock. So strike price selection is very important, right? So on the $10,000, if it's CSX, okay, then you do 3 contracts, because that's 103 contracts, right? If you're doing silver, then it's 5 contracts. Assume the same beta, right? Same volatility. But number of contracts, again, very common mistake. This is where you can get in trouble, right? If you have multiple position on spiders, $10,000 account, you have spider spreads, you have QQQ spread, and something else spread, or SMH spread, and then all of a sudden the market move 1%. Well, you're down $400 here, $200 here, and $200, and that's what you can get you in trouble. So strike price selection is the final rule, right? So again, I think the recipe for successful trading is, 1, have a clear opinion on cash, right? Second opinion is on number of positions. Third one is, your drawdown, right? Your stop loss, right? So your stop loss, that's the 2.5% of account value. Some people say, well, I always do 5% of underlying stock, but it has different beta, right? Different stocks move with different correlations, so you can't just do 5%. 5% of Procter & Gamble, it might take 3 months for Procter & Gamble to move 5%, but Tesla moves 5% every day, right? So then it's different. So that's why I use account value. And the fourth one is a strike price selection if you trade in options. So if you've mastered these rules, right, it doesn't happen overnight. You want to internalize this information, right? If I wake you up tonight in the middle of the night and ask you what are the 4 foundations or pillars of successful trading, right? What are those elephants named? Those 4 elephants that are holding the earth or trading is cash, number of positions, position size, and then strike price selection if you trade in option. Everything else I think will follow, right? Everything else will follow. You can find the services that give you signals. You can find the services that give you view on the market. But if you're not doing this correctly, if you're either overdoing it or underdoing it, then it doesn't really matter how good are the signals or how good anything else. At some point, if you have too many positions, you're gonna get caught, right? It's like the game catch me if you can. Sometimes bull market lasts, a few years and you don't get caught, but in this market, in the bear market, 90% of the people get caught, right? This is where you have to come to, I don't know what the right term is, but be honest with yourself and realize that you could have been lucky for the past few years during the bull market, and that's why your portfolio continues to grow. But in bear market, when market can move 20%, 30% in a matter of a couple of weeks, if you don't have those rules and you don't follow them, then that's kind of like a game of catch me if you can, right? At some point you're gonna get caught. At some point you're gonna get caught. So if you don't want to get caught, then these are the rules. And again, the reason I do 4 and 2.5, because again, psychology, 4 times 2.5, that means at any given point, your portfolio can move up or down 10%. If your portfolio moves up or down 10% in a volatile market, I mean, it's not, it's still hard and it's not super pleasant, but you can live, you can manage that, right? If market is dropping 30% and your portfolio is dropping 30%, well, then it's a problem. It's very hard to recover from 30% drop. And when portfolio moves 20, 30% every 2 months, well, you know that, it's very hard to deal with that type of volatility. Any questions? Thoughts on Roku, PayPal, Square? These are all, Roku and Square, they're all ARK, right? Part of ARK innovation. ARK is underperforming. So stocks like Roku, Tesla, for that matter, they're underperforming, right? Roku is kind of ARK. Can it continue going higher a little bit? Yes. Would I want to trade stock that's, has negative earnings? No. So Roku, again, my view is short-term bullish, maybe another couple of weeks. Best case scenario, maybe another, month and a half. But then next wave down, right? And stocks like Roku will lead the market to the way down. PayPal, Square, I don't see any difference in charts. To me, they look identical. Could there be a news in the company, Roku, I don't know, Amazon buys Roku or Netflix buys Roku? Okay, the stock is going to go up. I mean, can I predict that they're going to, buy them next 2 weeks? I cannot. Looking just at the chart, look at ETFs and indexes. To me, they look the same. Square, PayPal, I don't see any difference in these stocks. If you want to do fundamental analysis and you think Square, Bitcoin is going to come back and Square is going to take over the world, okay, then that's a different approach. That's bottom-up approach. I don't have a bottom-up approach. My approach is top to bottom. Bottom up, if somebody tells me, okay, Square is going to be the center of the universe, okay, and I believe that analyst, then maybe I'll follow it. But usually I'm top to bottom. BBY, same thing. I mean, yes, earnings matter. Best Buy announced earnings, nice rally. Above 200-day moving average. Not a lot of stocks above 200-day moving average and above 50-day moving average. Does it have legs? It's the same thing. Best Buy will continue rally as long as spiders will continue rally. So next, the rally will either end, next CPI print. When is the next CPI print? CPI. I mean, we do have, unemployment numbers. I don't know if that's gonna, when is next CPI report? December 13th, right? So December 13th, there's 2 things gonna happen after December 13th. Either we're gonna continue rally because, inflation is continue to going down, right? And better than expected, and at a higher rate, inflation is subsiding. Then the market has more room, right? Then it's going to continue maybe into the January, continue doing this, right? Continue doing this. I mean, that's scenario 1. It's possible. I'm not excluding this, right? Or after December 15th, right? We have a sharp pullback because inflation is not better than expected. It's either worse or kind of in line with expectation, and I mean, 7.5% year over year for many months is still a pretty hard reality, right? It's not a good numbers. Nobody I mean, it's better than 8.5, but it's not really an inflation that anybody can deal with. So, I mean, if it drops to 6%, okay, then we're in business, and then, but still, I think the signal is Fed has to pivot, right? When Fed is going to come out and say, you know what, we've done enough and we're comfortable with the risk, we're going to start lowering rates, not pausing, but lowering interest rates starting in March. Well, that's your sign that bear market is coming to an end. But as long as Fed stays hawkish and pauses and watches, companies going to have hard time growing you know, when the terminal Fed rate is at 5%, right? Historically, based on economics research, 5% interest rate is not good for the economy, right? It's not a conditions where the market can grow. There are exceptions, right? New industries, right? Maybe resurgence of Bitcoin and everybody's converting to Bitcoin, or I don't know, we're going to the Mars and everybody's moving to the Mars and everybody's selling real estate on Mars. And Elon Musk is the president of the United States. Okay, great. Then at 5% interest, then we can continue going higher. But those are outlier events, and you know it's very hard to predict them. All right. Done. Market is looking for excuse. I mean, okay, maybe it's one way to put it. Notice that every up move on spiders begins with W pattern. Yeah, I mean, it's a consolidation pattern. You can call it W, you can call it, people use it rectangle, head and shoulders. Doesn't matter what you call it, but it's just realize that market builds the bottom, right? It takes time. It usually takes time to build the top, right? I mean, it's not like it happens, you know, overnight, right? It takes time. It takes time to build the bottom, it takes time to build the top. You can call it rectangle, you can call it head and shoulders, but it's a consolidation pattern. These are all called consolidation patterns. Thank you, Kevin. Nizar, did I answer your question? Let me know if I answer your question. Oh, what question was, what symbol do I use to monitor? Sorry, let me just. One second. The question was, what symbol do I use? I mean, I don't know if this is universal, right? But US10Y. I don't know if this is everywhere. Let's see, bar chart is bar chart, or is it specific to trading view bar chart? Everybody has a little different notion, but if you're using bar chart, then it's something different, I think. US10Y euro next. Let's see. But that doesn't see euro. Yeah, that's different. Here. Then here. Yeah, I'm not sure what is on. Oh, TVC, hold on, TVC. No. Okay, so anyway, on the trading view, it's US10Y. I think you can also use TVC. TVC. No, you cannot. Okay. So US10-year yield. Do Roku fundamentals look very weak? Yeah, Roku fundamentals look very weak to me, right? in a high interest rate environment, you have negative earnings, and I assume your balance sheet has debt. It's very hard to refinance that debt, and it's very hard to service that debt. I'm not an analyst that specializes in Roku. I mean, I use Roku at home. I do earnings strategies. I mean, I understand what they do and how they make money. But, you know, I just glance, and if I see earnings per share is negative, to me, it's like a big red flag, big red flag until bull market restarts. You know, are they going to go bankrupt? Probably not. You know, somebody going to buy them? Probably yes. You know, but you know, is 55 the bottom? Probably no. Do I see a pretty good chance of 10-year yield coming down to 3? Yes, I think 10-year yield is heading to 3.5. Right, that's the support, the previous high from June. Right, and we're not that far. I mean, we already were at 365, so 350, 365. That's one-day price fluctuation. Is it traders at Mark? Tom, I'm not sure. There's few traders, so I apologize. But yeah, I'm not sure. 10-year T-bill value is not interest rate. Thanks for looking. Yeah, I'm not sure. I mean, this is, I think, specific to trading you. Nizar, Alibaba, China. I am very, you know, Alibaba FXI. It's the same thing as Roku. Right, a lot of risk. Right, doesn't look like they're going to reopen anytime soon. Right. As little as I know about epidemiology, you know, unless they have a herd immunity, right? There's 1.5 billion people or more, almost 2 billion people live in China. The only way to build immunity to COVID is what happened in every other country, right? You have to just, you know, vaccinate people, get sick, build herd immunity, and then it's contained. These lockdowns will go indefinitely, basically, right? Infinitely. It's never going to go away, right? So, you know, unless they change the zero COVID policy, China is at risk, right? And the regulation is at risk. So whether it's Baba, Baidu, you know, JD, I don't know, any other Chinese company, I would, same thing as Roku, right? Can it go higher? Okay, maybe it'll get to this downtrend, right? Maybe it'll get to 28, but then, you know, in March, this is not the low, right? It's going to go below 20. All right, my opinion, right? My opinion, if you're in bear camp, then it's going to go below 20. If you think we're in soft landing and, you know, China will reopen, okay, then it's different. Then yes, then we're heading higher. But, you know, I don't think we have reached the lows yet. Mark or Tom, okay, yeah, I agree. Yeah, I think the zero COVID policy just not going to work unless, you know. So they either need a new president or China is just going to go into recession, deep recession. I think they're already in recession. It's just they're hiding this. But you know, at some point, China is going to be a big risk to the market. All right. What else? VIX. VIX is back to 20, right? VIX is back to 20. So we were at this level, you know, August, right? That's what the August rally ended. This is where the April rally ended. Right? In the beginning of the year before the, you know, we were, you know, at 17. So okay, we can get to 18. It all depends, but it's already, you can tell, complacency, right? The idea of complacency. You don't want to be complacent. All right. Nobody's buying puts. All right. How do we help? A Tradespoon, there's different services. Again, so there's 4 rules, right? Cash, number of position size, strike price, but then what do you trade? I propose using Elite Circle. Elite Circle, you have to invest into education, especially in the bear market. This is not a buy and hold environment. You have to be on your toes. You have to listen to the news. You have, you know, so I do that for you, kind of, right? So you can participate morning bell, you can participate closing bell, but then every single trade you can set up SMS message And every time, you will get an alert what I trade, right? And it's going to be a combination. Some of it is going to be stock, some of it is going to be spiders, stock, ETF, some of them are option spreads, different services. But if you follow Spread Trader, Shadow Trader, Elite Trading Circle, these are all services where you get SMS messages. And Elite Circle, I have more than 4 positions because we have different services. So you have to be selective, especially if you're new. If you just want to do one at a time, premium, right? Premium is spread service where I just do 1 trade a week, right? 1 new idea a week. So you can start with spread or per premium. If you're more active, then Elite Circle, or if you want to learn, then I would join Elite Circle. If you're just looking for stocks only, robo investors. You already see that I'm using Stock Forecast Toolbox. Is one of my favorite tools. It's a neural network model, right? Artificial intelligence, a neural network. It's the framework that's Google uses and Meta uses, right? We didn't write our own neural network framework, but we use existing powerhouses to make sure that we are using latest greatest. We do have our own algorithm of which data we're feeding, how do we analyze the results. So that part is proprietary, but it's a framework that learns on data and makes predictions, right? So it basically predicted today 400 support, 403. You can see the band, the delta, the bands are constricting, right? Market is complacent, the bands are constricting, volatility is dropping, and model already sees that and it predicts, and it does a good job, right? Where's spiders right now? 402.47. So it sees that market is not going much lower than 400 or much higher than 403.61. So if you're a day trader, maybe buy at 400 and maybe sell at 403 or 404. So that's the range that the market is showing until the next news, right? If there is, unemployment numbers will come out next Friday, okay, then volatility will pick up, right? And the model will have to again train on the data and learn data. And there's no news today. It's kind of a slow market. We have a half a day. Okay, this is your range, and the trend is neutral, right? Trend is neutral, but it does see that in the next 10 days potentially reaching 410. So going into CPI print, we might be close to 410 or even as high as 415 level, right? That's what the model basically tells you. Right now, trend is neutral. In the next 10 days, trend is to the upside until the next big event that will, create new equilibrium between bulls and bears. But based on the current data, the equilibrium between bulls and bears, we're heading higher, probably getting to 410, 415 level. That's what the model says. Now you can zoom out and say, okay, what about longer term trends, right? You zoom out to 6 months, the trend is to the downside, right? It basically sees that 386, right? So it's not, you're not going to make predictions perfectly to the penny, but at 386, 404, 415, you're extremely overbought. Throughout the year, every lows and highs were met with probably 5% move, right? Model predicted 386 plus minus 5%. Because of the changes in volatility. So 5% of 386 would be around 416 level. But at this point, market is overbought, right? Doesn't matter what model you use or what, Fibonacci retracements, RSI, MACD, whatever indicators you want to use, they're all going to tell you the same thing. Market is extremely overbought. It needs to pull back. And the model does see that potentially in the next 6 months, we're going to reach the 300 level, which I also agree. I agree with the model. It is realistically to expect that somewhere between now and next 6 months, we are heading to 300 level. It's not going to be on April 1st, right? You can assume that it's going to be on April 1st. It could be on March 1st. It could be on February 1st. That model doesn't know, but it basically says the way things are now, the path of least resistance to the downside, you should not be surprised if we reach 300 level. That's what the model tells you. So I like this model, it's good. We have other models, research and screeners. I encourage you to review. Then we have the picks, right? If you trade in monthly options or longer term trades, weekly or active trader, it basically tells you, I can just look at active trader and see if, if Railroad is an uptrend, if Discover Financial is an uptrend, Cisco is an uptrend. We have a broad-based rally right now. These are 300 on spiders, right? So the model basically predicts that in the next 6 months, we will retest this level, right? We'll retest July 2019 level. That's what I'm on. So we're probably not going to hold the pre-pandemic high around 340. A lot of people calling for 340, but according to model, we're going to top out bottom down. We're going to find the bottom somewhere July 19 low or, you know, September 18 high, right? Before this is when the Fed tried to raise interest rates last time, right? November 18, we had a pretty big sell-off. So we're probably going to reach the bottom somewhere around this level. Nizar, let me know if you have any questions. All right, guys, I think I covered everything I wanted. Sorry about being late. I apologize for some technical issues. My site was down. Sorry, I paused the screen. So 300 is this level right here. So August 2019. If there are no other questions, that's all I have for today. Thank you very much. You guys have been awesome, and happy Thanksgiving again. Remember today, if you do have position, you know, our market is only open till 1 o'clock, and I will see you on. There's no closing bell today either, so I will see you on Monday morning. Thank you very much. Have a great weekend. Happy Thanksgiving. I appreciate you guys waiting for me and being part of my life, that I have this opportunity to present and share my experience. And I will see you on Monday. Thank you.